I think that is a particularly damaging potential side effect of removing IHT relief from AIM. The UK has really struggled to retain its fastest growing, most ambitious companies. And if you make it more expensive for them to raise money in the UK, they're more likely to go overseas. And we have seen that trend.
Hello, you're watching Proactive. I'm joined by Nicholas Hyatt. He's investment manager at Wealth Club. Nick, very good to speak to you today. You've put out a response this week to the London Stock Exchange's warning that removing inheritance tax relief from AIM was likely to result in significant market volatility. What's your view? How harmful could it be to investors and also small companies?
I think IHT seeking investors are a really, really core part of what makes AIM successful. When you think about how companies kind of grow up through AIM, they raise money from early stage investors, perhaps some venture capital trusts that also invest in AIM. And then they mature through to looking for that stable investor base, people that are going to be around for a long time and perhaps provide funding in moments of crisis in future. And that's where IHT investors come in. They're a very reliable, large part of the market, and they sit around in mature companies for an extended period. If you take away that investor base, you not only disrupt the whole flow of companies through AIM, but you also potentially make it a lot harder to raise money on AIM and therefore more difficult to achieve the valuations that small companies need to fund growth.
You've done some research into this. I mean, you said it's quite a high percentage of investors, IHT relief-seeking investors. What does your research tell you?
Well, actually, I think what's interesting is there's a perception that removing IHT relief from AIM would only hit those sort of mega wealthy investors, the people seeking IHT relief. The reality is that AIM is a much more diverse market. That, as I say, IHT relief seeking investors, an important part, but by no means the only part of that market. So we did some research this week that showed 15 to 20% of investment in AIM is actually from non-IHT seeking small companies funds. These are Marlborough, Liontrust, big name small company funds that choose to invest in AIM companies because they're attractive investments in their own right. They're fast growing. Yes, they're small, and that makes them high risk, but potentially high returning as well. And so there's this, as I say, there's a perception that if you pull IHT relief, you only hit those mega wealthy, inverted commas, tax dodging investors. But that's simply not true. You hit all of those non-IHT reliefing small companies investors as well. And I think that has the potential to do serious, long-lasting harm to the market and its reputation. A massive hit to UK smaller companies now has the potential to make them much less appealing in future as well.
So could it potentially become more expensive for small companies to raise capital on AIM?
Yes, so that is the flip side of lower valuations. When valuations fall, companies have to raise money at a lower price, which means that the cost of equity for those companies is increased. I think that is a particularly damaging potential side effect of removing IHT relief from AIM. The UK has really struggled to retain its fastest growing, most ambitious companies. And if you make it more expensive for them to raise money in the UK, they're more likely to go overseas. And we have seen that trend. AIM IPOs essentially fallen off a cliff over the last 18 months. And I think a lot of that is down to the uncertainty around the long-term future of AIM.
So you think there could be some serious damage if this was to go ahead?
I think it's inevitable. I think you see short-term volatility and long-term lower valuations.
Well, let's hope it doesn't get there. And Nick, thank you very much for your insights today.